Chinese buyers were paying a premium that made no economic sense, unless they knew something about Western inventory availability that official reports were not disclosing. Second, authorized participants in the two largest gold ETFs executed unusual activity patterns in the pre-market session. Large blocks of shares were being created, not redeemed. This meant institutions were moving capital into paper gold exposure, despite the fact that commercial traders, the banks and dealers who actually handle physical metal, were holding their largest net short position in commodity futures trading commission records dating back to 2006. Someone was betting heavily that prices would rise. Someone else was betting just as heavily that they would not. Both could not be correct. And yet both were increasing their positions with remarkable speed. Third, and perhaps most telling, the CME Group had quietly implemented margin requirement increases on February 7th. Not headline increases, not the kind that generate press releases, just a technical adjustment, raising initial margin requirements for gold futures by 12% and silver by 15%. To an uninformed observer, this appeared routine. To anyone who understands how leverage works in commodity markets, this was a weapon being loaded, because margin requirements determine how much capital a trader must post to maintain a position. When those requirements increase suddenly, traders with leveraged positions face an immediate choice: post more capital or liquidate. And when liquidation begins in a thinly traded market, prices move violently. The question was not whether volatility would arrive. The question was in which direction the violence would be directed, and who would be standing on the wrong side when it detonated. Reuters reported the surface statistics with clinical precision that morning. Gold was fluctuating in a tight range, holding above $2,150 despite the early spike. Silver had retreated slightly from its opening surge, consolidating near $3,340, but these prices were just numbers on a screen. The real story was buried in the microstructure, in the order flow data that only clearing members could see, in the whispered phone calls between vault operators and compliance officers. Because something was happening in the physical delivery system that had not happened in years. Delivery notices, formal declarations that a futures contract holder intends to take physical possession of metal rather than settle in cash, were being filed at rates that exceeded available eligible inventory in certain COMEX-approved warehouses. Not by a catastrophic margin, not enough to trigger emergency protocols, just enough to create friction, just enough to make the fulfillment process complicated. And in a market where complications can cascade into crises within hours, this was not a detail to ignore. The Bank for International Settlements had published its quarterly derivatives report just 6 days earlier. Buried in the appendices was a data point that went largely unremarked in financial media. Concentrated short positions in precious metals derivatives had reached levels comparable to late 2010, the period immediately preceding gold's historic climb to $1,900 and silver's spike to nearly $50. History does not repeat, but it often rhymes with disturbing precision. And the institutions who survived the last precious metal squeeze were now positioned almost identically to those who did not. By 9:15 a.m. Eastern, the initial volatility had settled into an uneasy consolidation. Prices were elevated but stable. Volume was heavy but orderly. To the casual observer, this was simply another day of heightened activity in a market known for dramatic swings. But to those who understood what the positioning data revealed, to those who recognized the pattern of margin adjustments and delivery complications and geographic price dislocations, this was not volatility. This was the beginning of something structural. The kind of beginning that does not announce itself with sirens. It whispers. And by the time the whisper becomes a scream, the exits are already locked. Because something was happening in the physical delivery system that had not happened in years. Delivery notices, formal declarations that a futures contract holder intends to take physical possession of metal rather than settle in cash, were being filed at rates that exceeded available eligible inventory in certain COMEX-approved warehouses. Not by a catastrophic margin. Not enough to trigger emergency protocols. Just enough to create friction. Just enough to make the fulfillment process complicated. And in a market where complications can cascade into crises within hours, this was not a detail to ignore. The Bank for International Settlements had published its quarterly derivatives report just 6 days earlier. Buried in the appendices was a data point that went largely unremarked in financial media. Concentrated short positions in precious metals derivatives had reached levels comparable to late 2010, the period immediately preceding gold's historic climb to $1,900 and silver's spike to nearly $50. History does not repeat, but it often rhymes with disturbing precision. And the institutions who survived the last precious metal squeeze were now positioned almost identically to those who did not. By 9:15 a.m. Eastern, the initial volatility had settled into an uneasy consolidation. Prices were elevated but stable. Volume was heavy but orderly. To the casual observer, this was simply another day of heightened activity in a market known for dramatic swings. But to those who understood what the positioning data revealed, to those who recognized the pattern of margin adjustments and delivery complications and geographic price dislocations, this was not volatility. This was the beginning of something structural. The kind of beginning that does not announce itself with sirens. It whispers. And by the time the whisper becomes a scream, the exits are already locked. What most investors fail to understand about precious metals markets is this. The price you see on your screen is not determined by supply and demand, not in the traditional sense. It is determined by a highly engineered system of contracts, clearing mechanisms, and institutional gatekeepers who possess the authority to rewrite the rules mid-game. And on February 10th, 2026, those gatekeepers were making moves that suggested the rules were about to change dramatically. Let's start with something most people never think about. The actual mechanics of how a gold or silver futures contract becomes a transaction. When a trader buys a gold future on COMEX, they are not buying gold. They are buying a promise, a legally binding agreement that on a specific future date, they can either settle the contract in cash or demand physical delivery of 100 troy ounces of gold meeting specific purity standards. But here's where it gets interesting. That promise is not guaranteed by the person selling the contract. It is guaranteed by a clearing member, one of approximately 20 major financial institutions authorized to facilitate trades on the CME Group platform. These clearing members are the invisible backbone of the entire system. Goldman Sachs, JP Morgan, Societe Generale, BNP Paribas. They stand between every buyer and every seller, absorbing counterparty risk and ensuring that contracts are honored even if one side defaults. And they have extraordinary power, because if a clearing member decides that a particular position is too risky, or that a client's creditworthiness has deteriorated, or that market conditions have become unstable, they can demand additional margin. They can force liquidation. They can refuse to facilitate new positions, all perfectly legal, all perfectly within the exchange rulebook, and all completely opaque to the public. On February 7th, 3 days before the COMEX Open that sent precious metals surging, these clearing members received updated risk parameters from CME Group. Initial margin for April gold futures increased from $8,900 per contract to $9,968. For March silver futures, the increase was even steeper, from $9,900 to $11,385 per contract. These numbers sound technical, but translate them into real-world impact. A trader holding 100 gold contracts suddenly needed to post an additional $106,800 in margin. Immediately. A hedge fund running 500 silver contracts faced a margin call exceeding $500,000 with zero advance warning. And if that capital was not posted within hours, positions would be automatically liquidated regardless of market conditions. Now ask yourself, why would CME Group implement such an increase precisely 3 days before a major price surge? One possibility is prudent risk management, raising requirements because volatility was expected. But there's another possibility that fits the data more precisely. Margin increases force weak hands out of the market. They eliminate leveraged speculators who cannot meet sudden capital demands. They create forced selling pressure, which temporarily suppresses prices, which allows well-capitalized institutions to accumulate positions at artificially depressed levels right before a planned move higher. This is not conspiracy theory. This is market structure reality. And it has happened before with stunning regularity. But the margin mechanism is only one control lever. Consider the physical delivery system itself. COMEX maintains a network of approved warehouses, facilities certified to store gold and silver that backs futures contracts. As of February 9th, total eligible gold inventory in these warehouses stood at approximately 17.2 million ounces. That sounds substantial, until you compare it to open interest, the total number of outstanding futures contracts. Open interest in April gold, futures alone represented claims on approximately 31 million ounces. Simple mathematics reveals the problem. If even a modest percentage of contract holders demanded physical delivery instead of cash settlement, the system would fracture. Now here's what makes February 10th particularly significant. In the 72 hours preceding the COMEX Open, eligible inventory dropped by 340,000 ounces, not transferred between warehouses, withdrawn entirely from the system. Simultaneously, delivery notices filed for March contracts spiked to levels 340% above the 3-month average. Someone was pulling metal out. Someone else was demanding what remained. And the institutions responsible for making delivery happen were caught in the middle. This is where the Shanghai Gold Exchange enters the equation. Unlike COMEX, which operates primarily as a futures market with occasional physical settlement, Shanghai functions as a physical delivery platform. Every transaction must be backed by actual metal in approved vaults. No naked shorting. No leveraged speculation beyond strict limits. And most importantly, No ability for Western banks to manipulate prices through unlimited paper contract creation. On February 10th, the Shanghai premium, the amount Chinese buyers were paying above the London spot price, reached $38 per ounce. Historically, this premium averages between $2 and $8. A $38 premium indicates one of two things. Either Chinese buyers have lost all sense of economic rationality, or they have information about Western inventory availability that justifies paying significantly above global prices to secure physical metal immediately. The latter explanation fits the evidence, because if Western vaults are running low on deliverable inventory, and if margin pressures are forcing leverage shorts to cover positions, and if physical demand from Asia continues accelerating, then the entire pricing architecture built on fractional reserve futures trading begins to collapse. Not slowly, not with warnings, but suddenly, catastrophically, and irreversibly. The clearing members know this. The exchange operators know this. The central banks whose gold leasing programs quietly supply the market during stress periods, they know this too. And their actions in early February suggested they were preparing for something. The question was whether they were preparing to prevent a crisis or to profit from one they had already set in motion. And global investors were watching. Foreign holdings of U.S. Treasury securities had declined for 7 consecutive months through December 2025. China's Treasury portfolio had fallen to $778 billion, down from $1.3 trillion just 4 years earlier. Japan, traditionally the most reliable buyer of American debt, had reduced its holdings by $63 billion in the fourth quarter alone. Someone had to absorb the $1 trillion in new issuance the Treasury Department planned for the first quarter of 2026. If foreign central banks were stepping back, if domestic commercial banks were already saturated with government debt, if money market funds were reaching regulatory concentration limits, then the Federal Reserve itself would be forced to resume Treasury purchases despite its stated commitment to quantitative tightening. Printing money to buy government bonds, monetizing debt, the endgame of every fiat currency system throughout history. And the market knew it. But the fiscal pressures were amplified by geopolitical developments that remained underreported in mainstream financial analysis. The BRICS summit, scheduled for March 15th in Sao Paulo, had an agenda item that should have dominated every central bank strategy session across the Western world. Formalization of a commodity-backed trade settlement mechanism, not a BRICS currency exactly, but a system allowing bilateral trade between member nations to be settled in a basket weighted toward gold, oil, and strategic minerals rather than exclusively in dollars. Russia and China had already been conducting energy transactions outside the dollar system since 2023. India and UAE had established rupee dirham trade channels. Brazil and Argentina were exploring South American regional settlement mechanisms. These were not hypothetical proposals. These were operational systems expanding in scope and volume, and each bilateral arrangement that bypassed the dollar reduced global demand for Treasury securities and dollar reserves. The geopolitical fragmentation was accelerating monetary fragmentation. And precious metals were the only asset class with no counterparty risk, no political allegiance, no dependency on any single nation's fiscal discipline. Then overlay the energy equation. Brent crude had climbed to $89 per barrel by February 9th, despite global economic growth forecasts being revised downward. This was not demand-driven pricing. This was supply concern, OPEC production discipline, Middle Eastern tension premium, and currency debasement all compounding simultaneously. Higher energy costs feed directly into inflation metrics, which pressure central banks toward tightening, which stress debt-laden governments and corporations, which ultimately force monetary authorities to choose between controlling inflation and preventing financial collapse. They will choose preventing collapse. They always do. And the moment that choice becomes obvious to market participants, the flight from currency into tangible assets accelerates exponentially. Corporate treasury departments were already responding to this reality. MicroStrategy had announced an additional $600 million Bitcoin purchase on February 3rd. Tesla had quietly added $340 million in gold to its balance sheet in Q4 2025, according to SEC filings. Even traditionally conservative firms like Johnson & Johnson and Procter & Gamble had disclosed strategic precious metals allocations in recent quarterly reports. When corporate CFOs start treating gold as a treasury asset rather than a speculative commodity, when sovereign wealth funds accelerate physical bullion purchases despite elevated prices, when central banks continue net buying for the 18th consecutive quarter, the message is unmistakable. The current monetary system is not sustainable. The only debate is timing. And February 10th, 2026 was increasingly looking like the moment when timing compressed into immediacy. Because all these pressures, monetary, fiscal, geopolitical, energy-related, do not operate in isolation. They compound. They reinforce. They create feedback loops that transform gradual deterioration into sudden phase transition. And precious metals markets, with their unique position at the intersection of currency, commodity, and crisis hedge, become the seismograph recording tremors that most people cannot yet feel. The COMEX surge was not about gold and silver. It was about everything gold and silver represent when trust in institutional promises begins to fracture. While traders fixated on minute-by-minute price fluctuations on February 10th, a far more consequential reality was unfolding across global monetary systems. The precious metals surge was not happening in isolation. It was a symptom of structural fractures that had been widening for months beneath the surface of official economic data. And those fractures were now approaching critical threshold. Start with the Federal Reserve's impossible position. On February 5th, Chairman Powell had delivered testimony to the Senate Banking Committee that was remarkable, primarily for what it refused to acknowledge. Inflation data for January 2026 had come in at 3.8% year over year, significantly above the Fed's 2% target and accelerating for the third consecutive month. Core PCE, the Fed's preferred inflation gauge, registered 3.4%, the highest reading since October 2023. Under normal circumstances, this would demand immediate monetary tightening, rate increases, accelerated quantitative tightening, hawkish forward guidance. But Powell offered none of these. Instead, he spoke of monitoring conditions and remaining data-dependent and maintaining flexibility. Translation: the Federal Reserve had lost control of the narrative because the bond market was sending a very different signal than the equity market. The 10-year Treasury yield had climbed to 4.73% by February 9th, its highest level since November 2023. But the 2-year yield had simultaneously dropped to 4.21%. This inversion, this unusual configuration where short-term rates exceed long-term rates, historically precedes recessions with disturbing consistency. The market was pricing in future rate cuts, not because inflation was conquered, but because economic deterioration would eventually force the Fed's hand regardless of price pressures. And here's where precious metals enter the equation. Gold and silver do not rally because investors are optimistic. They rally when investors lose faith in the purchasing power of currency itself. When the choice becomes holding depreciating dollars or holding tangible assets with 5,000 years of monetary history, the decision becomes simple. But the Federal Reserve's dilemma was only one piece of a much larger puzzle. Consider the fiscal situation that was simultaneously developing in Washington. The Congressional Budget Office had released updated projections on January 28th that received minimal media coverage despite their staggering implications. Federal debt held by the public was projected to reach 106% of GDP by fiscal year 2027. Interest payments on that debt were forecast to exceed $1.2 trillion annually, surpassing defense spending for the first time in American history. And the primary deficit, the gap between revenue and spending excluding interest costs, showed no path toward improvement under any politically feasible scenario. This was not a crisis of liquidity. This was a crisis of solvency masquerading as business as usual. And the debt ceiling suspension that had provided temporary relief was set to expire on March 1st, 2026, exactly 19 days after the COMEX session that sent precious metals soaring. Treasury Secretary Yellen had already begun sending letters to congressional leadership warning of extraordinary measures that would be required if the ceiling was not raised or suspended. Translation: the United States government was weeks away from potential technical default, not because it lacked the economic capacity to service debt, but because political dysfunction had transformed routine fiscal management into existential brinkmanship. This scenario would be implemented during acute crisis, perhaps triggered by currency collapse in a major economy or sovereign debt default that threatened contagion. The timeline would be measured in weeks. Emergency declarations. Congressional authorization bypassed through executive authority claims. Media cooperation in framing the measures as necessary stability interventions. Politically connected institutions would receive advance notice allowing repositioning. Ordinary holders would face sudden illiquidity and forced sales at disadvantageous terms. The veneer of market-based price discovery would be abandoned in favor of administered outcomes. This was not speculation. This was documented historical pattern. And every legal framework necessary for implementation remained on the books in modified form. So which scenario was most probable as February 10th transitioned into the following weeks? The honest answer: none in isolation. Real-world outcomes rarely conform to clean analytical frameworks. More likely was a hybrid progression, controlled unwinding attempted first. Supply shock elements emerging despite intervention efforts. Policy overrides implemented selectively when market solutions failed. The exact sequencing would depend on variables impossible to predict with precision. A geopolitical shock that accelerated timeline. A major dealer default that forced regulatory response. A currency crisis in an unexpected jurisdiction that created contagion. But Certain principles remained constant regardless of pathway. Physical allocation provided optionality that paper contracts could not match. Counterparty risk had become the dominant consideration overshadowing price optimization. Geographic diversification offered protection against jurisdiction-specific interventions, and liquidity premium, the ability to convert assets into usable currency rapidly, would potentially exceed fundamental value during transition periods. Individual investors faced a stark choice: participate proactively in the restructuring, or be subjected to outcomes determined by institutions prioritizing their own survival above all else. February 10th, 2026 would be remembered not for the price levels achieved that morning, but for being the moment when the underlying fragility became undeniable to anyone willing to examine the evidence objectively. The metals surged, the banks positioned, the margins tightened, and the endgame scenarios transitioned from theoretical analysis to operational probability. What happened next would determine which scenario manifested, but that the current system was unsustainable, that reality was no longer debatable. February 10th, 2026 was not the conclusion of a story. It was the opening chapter of a sequence that would unfold across the coming weeks and months, with consequences extending far beyond precious metals markets. The positioning was complete. The structural tensions were visible to anyone willing to look beyond surface narratives, and the range of probable outcomes had narrowed to a handful of distinct pathways, each with dramatically different implications for institutional survival and individual portfolio preservation. Understanding these scenarios requires abandoning the comforting illusion that markets operate on fundamentals alone. They do not. Markets operate on the interaction between fundamentals, positioning, and the institutional capacity to manage systemic stress. When all three align, transitions happen smoothly. When they misalign, transitions become dislocations. And the evidence from early February suggested profound misalignment. The first scenario, the one most institutional risk managers were quietly hoping for, involved controlled unwinding. In this pathway, the concentrated short positions held by commercial banks would be gradually reduced over a 6 to 18-month timeframe through coordinated intervention. Central bank gold leasing programs would quietly supply physical metal to ease delivery pressures. The Federal Reserve and European Central Bank would establish currency swap lines allowing foreign institutions to access dollar liquidity without forced asset sales. Regulatory agencies would grant forbearance on position limits and concentration rules, permitting major dealers to roll contracts forward beyond normal expiration schedules. Media narratives would be carefully managed to prevent retail panic buying that could overwhelm distribution networks. Prices would be allowed to appreciate, but within tolerance bands that prevented destabilizing velocity. This scenario required unprecedented coordination, the Bank for International Settlements orchestrating among G7 central banks, COMEX and London Bullion Market Association harmonizing delivery schedules, major clearing members agreeing to absorb temporary losses in exchange for regulatory protection. It was technically possible. Similar interventions had occurred during the 2008 financial crisis, when gold lease rates spiked and physical premiums threatened to break the paper pricing mechanism. But 2026 was not 2008. The fiscal capacity for bailouts had diminished dramatically. Political tolerance for rescuing financial institutions had evaporated. And most critically, the emergence of alternative pricing mechanisms in Shanghai and Dubai meant Western authorities no longer possessed monopolistic control over precious metals price discovery. If this controlled unwinding scenario succeeded, institutional winners would be those who accumulated physical metal early and maintained positions through volatility. Commercial banks would survive with reputational damage, but intact balance sheets. Sovereign wealth funds would emerge with enhanced purchasing power. The monetary system would limp forward with credibility, wounded but functional. But success required everything going right simultaneously. And markets rarely cooperate with institutional preferences. The second scenario involved supply shock cascade. This pathway began with a relatively modest trigger, perhaps 8% to 12% of April gold futures contract holders demanding physical delivery instead of cash settlement. Under normal circumstances, COMEX warehouses could accommodate this, but circumstances were not normal. Eligible inventory had been declining steadily. Delivery notices were already elevated. And if even a fraction of institutional longs decided to test the system's capacity, the mathematics became catastrophic. Authorized participants would scramble to source physical metal. Premiums for immediate delivery would spike above $100 per ounce. Smaller dealers without access to refinery output would begin defaulting on obligations. COMEX would face an impossible choice: allow the default cascade or invoke force majeure provisions, allowing cash settlement at arbitrary prices. If force majeure was declared, confidence in paper contracts would evaporate instantly. The Shanghai premium would explode to $200, $300, potentially $500 per ounce as Eastern buyers recognized Western inventory insolvency. Retail investment demand would surge as news coverage shifted from financial reporting to crisis narrative. Physical coin and bar dealers would be overwhelmed within days. Mints would ration production. Spreads between paper prices and physical availability would reach levels that shattered any pretense of unified global pricing. This scenario would unfold rapidly, 30 to 90 days from trigger to full dislocation. Mining companies would see equity valuations multiply despite unchanged production metrics. Physical holders would experience wealth preservation as currency purchasing power collapsed. But the broader financial system would suffer severe stress. Derivative chains built on precious metals pricing would break. Pension funds with commodity exposure would face unexpected losses. Regulatory agencies would implement emergency trading halts and position limits. The controlled system would give way to chaotic repricing. And once begun, this cascade would be nearly impossible to reverse without fundamental restructuring of the monetary framework itself. The third scenario was perhaps most unsettling because it involved deliberate policy intervention that overrode market mechanisms entirely. This pathway assumed authorities recognized the systemic threat posed by precious metals dislocation and responded with coercive force rather than market-based solutions. Historical precedent existed. Executive Order 6102 in 1933 prohibited private gold ownership in the United States. Similar confiscations occurred in Europe during both World Wars. Modern implementation would be more sophisticated but equally effective. Windfall taxation on precious metals, gains above certain thresholds, perhaps 70% or 80% tax rates on profits, restrictions on bullion dealer operations, requiring licenses that could be revoked for hoarding, mandatory reporting of physical holdings above modest amounts, prohibition of new purchases except for industrial use with strict documentation, capital controls preventing precious metals export, and critically, government-mandated pricing that divorced official settlement rates from actual market clearing levels. The International Monetary Fund could facilitate this through special drawing rights for valuation that included a gold component, effectively creating a two-tier market where official institutions transacted at one price, while private holders were restricted from accessing that price.